Hi, it's Corey, and today I'm going to talk to you about the 4 ways that real estate can make you money and how you can use those to compare a real estate investment to other types of investments, such as stocks or index funds, um, to get you an apples to apples or close to that comparison. So let's dive in. I'm going to share my screen. So the 4 ways that real estate can make you money is cash flow, loan paydown, appreciation, and tax benefits. So let's talk about these. Cash flow, real simple. If you bring in a certain amount of money that as your gross income, and then you subtract the expenses, but not counting the loan payment, then you get something called net operating income. And then from that, if you subtract the loan payment, you get your cash flow. This is the cash left over every month that the real estate can put in your pocket. Mailbox money. It's what everybody wants. This is what everybody focuses on. And it's pretty cool. But it actually, in a lot of cases, might even be the smallest of the 4 ways that real estate's making money. And I think people do make a mistake in focusing on this to the exclusion of the other 3 areas. Cash flow, if you're looking at it, there might be a property where let's say you're getting a 5% cash on cash return. So if you take your cash flow divided by the money you have invested over the course of a year, it's 5%. If you had $100,000 in, you got $5,000 of cash flow. You might look at that and say, well, the S&P 500 last year did 15% or whatever it did. So how is this going to compare to that? That's a pretty bad deal if I'm only getting a 5% return. The problem here is you're looking at only one aspect of your return. So let's move on to the next one. The cash flow, well, I guess sticking to that for a second, the cash flow, if you want to compare that to something with like a stock or an index fund investment, really the analogous thing is the dividend. That's the cash that your stock is going to kick out without you having to sell the cash. It's not the change in value of your stock. It's just the cash it kicks out. That's very similar to that's basically what you would compare to your cash flow. So if a stock has a dividend of say 2%, and your real estate has cash flow of 5%, clearly the real estate's winning. So number 2 is loan pay down. Remember, your cash flow doesn't include your mortgage payment, and a portion of your mortgage payment, unless you're interest only, it's usually going to principal. And the portion that's paying down that principal is a return that you are getting. You may not see that money in your pocket right now, but it is reducing the loan that you owe. Therefore, it's increasing your net worth. And whenever you go to refinance or sell that property, you will see that money then. You will see it. And so it is a real return that you need to include. So if you got 10,000 bucks of cash flow, but you also over the course of the year paid off $10,000 of your loan, the tenants have really added $20,000 into your net worth. So number 2 is loan pay down. Number 3 is appreciation. Now, a lot of people would confuse this with speculation, and sometimes it is speculation. If you buy in an area and you just hope that the market's going to go up, maybe you have good reason to believe that. Nothing wrong with that, but that would be speculation. But in this case, appreciation can also be forced. I did a whole nother video on this titled Economics of Multifamily Real Estate Investing, where I go into a whole bunch of math. But basically, if properties are valued on a cap rate, you're buying income, so every dollar of income is worth so much value. Then if you bring in more income, the property's worth more money. So a common cap rate these days might be 8%. Some parks trade at lower, some are higher. I've seen them down in the 5s. I've heard of some at 3s and 4s, which is crazy. But let's just say take an 8% property. So your rule of thumb for an 8% property is for every $2,000 of income that you can increased income that you can generate over the course of a year, it's going to raise the value of your property by $25,000. So if you can find a way to bring in $8,000 more income, whether that's filling vacant lots, bringing rents up to market, fixing that broken pipe so that your water bill reduces, cutting some other expense. If you can do those things, if you can raise it by $8,000, you raise the value of your property by $100,000. When you go to sell it, someone is willing to pay that much more because your property is bringing in that much more money. It's just simple math, but it's pretty cool math. So 8,000 equals 100,000. So not only do you get your $8,000 more of cash on cash return, but you just increase the value by $100,000. And then when you go to sell or refinance, once again, you can realize that money. So there is a return metric before I get into tax benefits called IRR. A little tricky to calculate using an Excel function or a financial calculator, but your IRR basically calculates your total return that you made over time, an annualized percentage return And it includes how much money you put in, it includes your cash flow, it includes your loan pay down, and it includes your appreciation. And so if you want to compare a real estate investment to a stock investment, let's say the S&P 500, and you went in and punched in, went into some website to figure out what it did. And if you reinvested the dividends, let's say it returned 15%. Some years it's up in the 20s, some years it's negative 15%. But let's say last year it returned 15%. And I think over a long time average, it's more like 8. So let's say it's an 8% average. You would compare the IRR, the projected IRR of a real estate investment to that. So if its long-term average is 8%, and you've got a deal that's, and it's got a, say, 2% dividend, and you're looking at comparing that to a real estate investment that has a 5% cash on cash year one, maybe climbing to 10%, 11, 12, 13, 14% by year 5. Those dividends are probably staying at 2. Um, um, and it's got a projected 15 or 20% IRR over a 5-year period. That's going to beat the heck out of an 8% long-term average S&P stock market thing. Not that the stock markets are bad; those are good. There's pros and cons, right? You have to do a lot more evaluation with the real estate, and the S&P 500 is very diversified. I think they all have places in your portfolio, but a lot of people I hear a lot of people just get confused with that cash on cash return, and then looking at the S&P 500 for the last couple of years when it's been screaming high and trying to compare the two, and they're really apples to oranges. You need to add in the loan pay down, and the appreciation is the biggest of them. So you need to add that in there to compare it. Because the appreciation is the change in value of your real estate, and the biggest piece of the S&P 500 return is the change in value of the stock, right? So that's really what you would be comparing. The tax benefits is the fourth. Both stocks and real estate have different forms of these. I'm not going to dive too far into them, but some easy ones. Let's say you didn't do anything else and you just reported all of the cash flow, all of the profit as income when you're from your day-to-day rent collections. That money that you got would be taxed as passive income, which means there's no FICA taxes. So already, if you compare that to, like, what if you made that much money in a job, you're already saving money because that's another 7.5% that you don't have to pay with the FICA taxes because it's passive. In addition to that, there's depreciation, which is a write-off that they let you take because things do wear down over time and they recognize you'll have to replace them. But it's a write-off that they let you take where it's a loss that did not come out of your bank account. So you can take this loss to offset some of that income and pay no taxes on it now, and not really lose the money. So that's actually really, really powerful. And you do, when you sell, have to recapture all of that. But there's ways around that too. Maybe you just never sell and you do a refinance, or there's 1031 exchanges. So there are ways to mitigate even the future implication of that. But even if you do sell later and pay the tax later, money now is more valuable than money later, because you can take that money and invest it for the time being. And 10, 15, 20 years later, when you sell, you'll have to pay that money back, but you've been able to make returns off of that money all the time. So even if you pay it back, it's still great. Then there's also a bunch of other things. Bonus depreciation is a huge tax benefit if you go get a cost segregation study, which is kind of, if you're in a syndication or something where it's big enough to justify one of these cost segregation studies, you can receive a huge write-off year one with that. So there's a whole bunch more. I'm not a CPA. Please talk to your CPA. Don't do anything based on this without talking to an actual CPA. But these are the 4 ways with real estate. So, and that's how, once again, just to sum it up: cash flow, loan pay down, appreciation, and tax benefits. And if you want to compare these to a stock or other investment, cash flow you would compare to the dividend on a stock, and the IRR, which accounts for cash flow, loan pay down, and appreciation, you would compare to the total return on a stock. Hope that was helpful. Cheers.